This lecture is about the decision process we go through to decide which pairs to trade. We will rehash some of the information from the previous lectures and bring some more insight into my decisions with regards to what currency pairs to trade. When choosing which pairs to trade, there are a few things to consider. First off, spread. If you are scalping, meaning you're in and out of trades quickly, then spreads can add up very quickly and take up a fair percentage of your trades. For example, if you are trading, say, 10 times a week and your average cost is 2.5 pips, that means that you are spending 25 pips in brokerage fees, whereas if it costs you 5 pips, then you're spending 50. Now, it may not sound like a lot, but 25 pips is a reasonable trade on a scalp, which you are effectively losing every single week. So let's say 2 trades a day. Additional 2 pip cost from more expensive brokers is 4 pips a day or 80 pips a month. That could be $800 just down the drain. The cheaper pairs are the more traded ones, and 9 times out of 10 it's always the euro dollar. Choosing a session or choosing a pair based on sessions, for example, the Eastern pairs aren't always busy, so stick to the times where they are traded, and London is pretty much busy across all of the different Forex pairs available. I personally recommend you try out the Aussie dollar as well. It's recommended as an easier currency pair to be trading. Slightly increased spreads from the euro dollar, but it does seem to be a lot smoother and is a great way to practice longer term strategies. It's not so great for scalping, but if you're willing to hold trades for a day or two, then the Aussie dollar is very often a nice one to go for. Exotic pairs can cost 50 pips or more. For example, if the euro dollar averages around 2.5 pips, you'll find that trading the South African rand versus the British pound can cost 150, 200, sometimes even 300 pips, which means you would have to cover all of those pips just to break even on your trade. So how is money traded in the market? Well, like we said before, it's a simultaneous buy and sell of 2 currencies. For example, the euro dollar. We don't worry too much about the second half of the transaction because the broker is going to be doing all of that for us, so we usually just use the term buy or sell when we're referring to the base currency, being the one on the left. Imagine you are a tourist coming from the United States who is traveling to somewhere in the Eurozone. You need some euros, so you go and purchase 10,000 euros, and on that day it costs you $11,800 to purchase that. 2 weeks later, things don't work out and you can't travel, so you need to get your US dollars back. You head over to your travel exchange place and sell back your 10,000 euros, but now the exchange rate is 1.25, so you get back 12,500 US dollars instead. You have just made a profit of $700. This is, in essence, Forex trading. As retail traders, this is effectively what we are doing, just far more often and with other benefits like using leverage. But be careful of leverage. We will discuss this more and more, but leverage is not always your best friend.